Okay, guys, I got to tell you, this is the funniest thing I've ever seen. So we're on this cruise, right? And they have these game shows, and they have each couple, like a spouse, come up, and they're asking them questions, and then they bring the spouse out. So the lady on the end, and they're like, "What's your biggest complaint?" She's like, "My husband, frankly, he's lazy. I wish that it was like when we were younger." And he basically sits around and watches TV all day. And they're like, "Well, bring him out." They bring him out, and he's in a wheelchair.
It wasn't like a joke. She didn't laugh.
It was not a joke.
Welcome to Drunk Real Estate.
Grab a drink and enjoy the show.
Hey there, welcome to episode 80 of Drunk Real Estate. I am Kyle Wilson, Ashley Wilson's husband, and today we're going to switch it up a little bit. We have a special guest today because I'm joined by only my two favorite co-hosts, starting with Mr. Jay Scott. How's it going, Jay?
I'm hanging in. It's been a rough few days. I'm a little sick. I think whatever you had last week, Kyle, you gave to me. So I'm here with a big glass of water, big cup of green tea, hot green tea. And then I broke out the bourbon because I'm definitely going to drink. I just can't do red wine today.
Jay, you strike me as a man cold guy. Like this is a man cold you have. And I had legitimate pneumonia. So I don't think you should be comparing what I had to you had there.
I find it funny that you're so defensive about my illness and your illness. You need to compare.
Yeah, we are not the same, Jay. AJ, how's it going, man?
Going good. Well, to compare, I do have some congestion issues right now, so I don't know where that stacks up in it, but I might as well. Diet Coke, Red Solo.
Classic. Love it, buddy. And as you can see, Mauricio once again had better things to do. So today we are lucky enough to have Dave Meyer join us on the podcast. How's it going, Dave?
Great. Super glad to be here and happy to report that I'm in perfect health right now.
Nice. Did you bring something to drink for us?
I did. I got some bourbon, but then in honor of Jay, I brought red wine. I know that he always drinks red wine, and then he abandoned me and switched it up. But I'm sticking with what I got because I started drinking 30 minutes ago.
I always drink bourbon, and Jay always drinks red wine, and obviously we know who your favorite is.
I don't know you well enough yet, Kyle, to know that you always drink bourbon. I can go upstairs. There's plenty of bottles.
Well, we're going to get to know each other pretty well here because I actually made myself a full drink today. I made myself an old fashioned. I usually just get lazy and just pour bourbon on the rocks. But I had a brand new bottle of this Evan Williams. Look at this beast.
That's beautiful. The 100 proof. I love it.
It's a bottled in bond. It's excellent for making old fashions. And it's only like $40 for like a liter and a half.
Is that a full handle? I was going to say, I didn't know. I don't know many adult men who buy handles, but I respect it a lot.
No, you got to, if you're a bourbon drinker, it's a little harsh if you're just going to drink it like straight. But as far as like making it into like an old fashioned or something, it's got a lot of flavor. So it's good. Highly recommend. Well, so for those of you who don't know, Dave is the head of real estate investing for this little website. It's called BiggerPockets. I don't know if you've heard of it, where he specializes in data analytics and research.
I have a question. Wait a second. Before you go on, what does this mean? Head of real? Is this a new title? Did they make up this title for you? Because I thought
I'm going straight off of LinkedIn here. This is where I'm pulling this.
I made it up. It was just like one of those networking things where you just got to write your name and your title on a card, and I just made it up. And
you are my hero.
It literally says head of real estate investing on BiggerPockets. So he used to be VP of data and analytics. So I like that. I like the description of that one more. So I kind of rolled with that, but I gave him his proper title. He's also the host of the BiggerPockets podcast, which doesn't say in his LinkedIn, but so that must be a new thing. You got to update your LinkedIn, buddy. I think that's a new thing.
I'm not good at that.
But I know because he is a host of On the Market podcast as well, and the author of the book Start with Strategy, among other publications. So we're really happy to have you, man.
Among other publications. He is the co-author of one of the greatest real estate books ever written, Real Estate by the Numbers. He was the inspiration and the motivation behind.
No, you definitely were the inspiration.
Okay, I might have been the inspiration. You were definitely the motivation.
Jay, didn't you used to be able to write books on your own? Now you need help? Wow, like it's just
literally 2 years. 2 years into my writing at BiggerPockets said we need to get you some help, and they assigned me Dave. And a year and a half later, we had one of the best books ever.
So I do have a couple questions for you, Dave, because as I said, I was on your LinkedIn, and apparently you're living in Amsterdam right now, according to LinkedIn.
Not anymore. Man, I really got to update that LinkedIn. Not anymore. I was until maybe 6 weeks ago. And then I just moved back to the States and now I'm living in Seattle.
All right, cool. That's what I thought, but I just it was listed twice, so I was like, wow, it's obviously a thing.
I really wanted you to know. I wrote it out twice. No, my wife was transferred there for work 5 years ago, and super cool experience. But happy to be home now.
Yeah. I lived in Europe quite a while, so I feel like everyone should go and spend some time over in Europe. It gives you a little bit of perspective to Americans' problems. My next question is: do you own BiggerPockets?
I wish. I do not.
I was just wondering because I went and checked out their YouTube page, and it sure looks like you do. Your face is at the top. You're on the logo, and every single episode is of you.
Oh, wait a second. Whoa. What's that one up a little bit higher? Oh, that guy is good looking.
Like there are other people who work there, right?
Not of consequence, apparently.
Is that crazy? Above the fold on that page, the BiggerPockets YouTube page, there were only two people's pictures, Dave and mine.
You and me. Yeah, I am not responsible for the thumbnails that are created. Believe me, I wouldn't be doing all the like Macaulay Culkin shocked YouTube faces if I had any pull on this.
We had producer Alex do a photo shoot for us of that. That's where all of ours come from. Well, we appreciate you coming on the pod. You are my second favorite personality in BiggerPockets, so I'm really excited to have you here.
Who's your first? I'm glad to be second.
You want to guess, or?
I mean, there's a lot of good ones. Brandon,
well, I'm not gonna say because I have two. Actually, there's a couple people who probably would expect that they're first.
Okay,
but maybe we'll talk about the next episode. This episode, we're talking about something super nerdy. So if you want to skip past this segment to go to the interesting segment that Dave's leading, this is just Jay's segment. This is gonna be the one that most people are gonna skip over because we're talking about the debt limit ceiling. So it's that time of year again. Once again, in 2024, the government went and spent too much money, so we found ourselves with another debt ceiling, quote unquote, crisis. This time, however, it's extra special because we're in an election year, plus we have a president whose party owns both Congress and the Senate. Fun fact, I'll go to AJ from this. We actually discussed the debt ceiling limit on a previous episode. AJ, can you guess which one? This was supposed to be a question for Jay, but then I saw that he was in the notes and reading it, so I'm sure he went back and looked. So Jay, you got the answer? I
don't.
It was episode 1. Our first episode, we talked about the debt ceiling limit, and that was back from 2023 when they were trying to bend Biden over there, and it went right up to the edge, and Filch downgraded us, and it was a whole issue. So we talked about it way back then. So if you want to go back and get a primer to what we're going to talk about, episode 1. Actually, we were pretty bad back then. Don't go back. Just listen to this one. So we're due for another discussion is what I'm saying, because that was a long time ago. So Jay, we already touched on this. Give us a brief refresher on what a debt ceiling is and why we're caring about it this year in 2025.
Yeah. So first, a little bit of a correction. You said because we spent so much money in 2024, it became an issue. Yes, we spent a ridiculous amount of money in 2024, but the reality is it was going to be an issue no matter how much or how little money we spent. And I'll get to that in a minute. But real quick. So what is the debt ceiling or the debt limit, depending on your favorite verbiage? Basically, it is the total legal amount of debt that Congress says that we're allowed to create at any given time by the federal government. This is the total amount of national debt we're allowed to have at any given time. And Congress votes and passes legislation that says this is the upper limit. The reason for that is basically up until about, I think it was 1917, Congress has always needed to approve the money that gets created by the Treasury, the money that goes into circulation and gets used to pay for stuff. But I guess back around 1917, they were doing it a lot, and it got cumbersome every time the Treasury needed to pay a bill or borrow money, that they had to go to Congress to basically raise the debt limit, to approve creating more money. Congress basically said, we're going to set this debt limit, which will allow the Treasury to borrow money or create money out of thin air up to a certain level without our approval. So this way they can basically pay their liabilities, they can pay interest on their debt, do the stuff they need to do so that they don't have to get Congress's approval every time they borrow a dollar or print a dollar. Throughout history, I mean, we've raised the debt limit, the debt ceiling all the time. We've raised it 78 times since 1960. We've raised it 12 times just since 2011. So 12 times in the last 14 years. And so I guess the big question is, what happens if we reach the debt ceiling and Congress doesn't increase it? Well, basically, the government can no longer create new money. They can't issue new debt. And the Treasury is now limited to whatever cash they have on hand to basically meet their obligations. They can use their cash on hand to pay federal employees. They can use their cash on hand to pay interest on the debt, to pay Social Security, Medicare, Medicaid, all those things. If they run out of cash on hand, there is some creative accounting they can do that basically they call them extraordinary measures. So there are some other things they can do. So based on that, essentially, we hit the debt limit and we're screwed if Congress doesn't increase it. So how do we get to today? Well, back in January of 2023, there was a big fight over the debt limit, the debt ceiling, and Congress basically said, we don't feel like dealing with this right now. So instead of raising the debt ceiling to some arbitrary amount for some arbitrary amount of time, back in January of 2023, what they said was, we are literally just going to suspend the debt ceiling, meaning we can print as much money as we want. The Treasury can borrow and create as much money as they want until January 1st of 2025. And whatever the national debt is on January 21st or January 1st, 2025, that's where the new debt ceiling is going to be when we hit that day. And if you're following the calendar, we hit January 1st about 2 weeks ago. And so whatever the debt was 2 weeks ago, that is the new debt ceiling. And as of today, the Treasury can't print more money. They can't issue new debt. So what are we doing today? Why haven't we run out of money since January 1st? Well, there's a couple of reasons. One, Treasury cashed in about $50 billion in assets over the past 2 weeks. So they've got some cash on hand to pay their bills. Again, they can do some creative accounting, which will get them through a couple weeks, maybe even a month or two. And that should get us to February, March timeframe, at which point all of this tax revenue starts rolling into the IRS. That tax revenue flows into the Treasury's coffers. And now they've got literally trillions of dollars to keep the train rolling for a couple months. We'll run out of trillions of dollars probably by June. So this debt limit is an issue, but it's probably not an issue where we're at risk of defaulting on our debt until sometime in the May, June timeframe. That's the backstory. Now we can talk about why this is going to be an issue, given that we've raised the debt ceiling dozens of times, literally in the past 60 years, and a dozen times in the last dozen years. You might think, well, this is just something that Congress does and it shouldn't be a big issue. The reality is things are a little bit different this time. One, we've got a good bit of hypocrisy on both sides of the aisle. Democrats basically have always been in favor of printing lots of money and raising the debt ceiling and spending as much money as we need to spend. But I suspect with a Republican Congress, a Republican executive branch, Trump in the presidency, Democrats are probably now going to magically decide that they don't want to spend a lot of money.
Jay, back in December, didn't they already agree to raise it $1.5 trillion?
They did. They did. And I'll get into that in a second. But the other side of the aisle is that we have Republicans who have always said, we don't want to spend money. We don't want to raise the debt limit. We've got DOJ that's tasked with cutting $2 trillion from the budget so that we balance the budget. But then suddenly in December, Trump said, I want to get rid of the debt ceiling so I can print as much money as I want. And so both sides of the aisle are basically flip-flopping because obviously the political winds are.
I read that differently. I didn't read it that Trump was like, hey, I want to get rid of the debt ceiling so I could spend as much as I want. I read it that he doesn't want to have a Biden issue. He doesn't want to have an issue where like political adversaries, I'm not going to say just Democrats, because they are so tight, like they need every single Republican vote, like down to like single votes count. He doesn't want anyone to use it politically to against him. is kind of how I read it, more so than him wanting to spend as much as he wants. Because I mean, his thing is that he really wants to get the budget under control. So like he can't come out and say like he wants to spend as much as he wants, even though maybe he does.
Well, that goes to your point about it being a Republican-controlled Congress. The way I like to think of Congress right now is we used to have a two-party system. We had Democrats, we had Republicans. Whichever had the majority was probably going to get whatever they wanted passed. Today, we have a three-party system. We've got the Democrats who control 49% of Congress, or 49% of the House at least. And then Republicans are basically two factions. We've got the MAGA Republicans and we've got the quote unquote Rhino Republicans. And they have very different beliefs on whether we should be raising the debt ceiling, how much money we should be printing and borrowing, what the budget should look like. And so what we're likely going to see over the next few months is probably a much more difficult negotiation than we've ever seen. Historically, because Republicans controlled Congress, 51% of Congress, they would come up with the bill that they wanted. They'd all get behind it, and that's what they would pass, whether Democrats liked it or not, and vice versa if Democrats were in power. Now, there are going to be a few MAGA Republicans who are going to hold out on any debt ceiling increase, and certainly on a major debt ceiling increase, because their constituents are telling them that they want the budget under control. And so I suspect over the next few months, we're going to see a big, difficult negotiation where we're going to see a lot of concessions going every which way that have absolutely nothing to do with the debt ceiling. And when you talk about omnibus bills, these big bills that have like the kitchen sink thrown in, they're not just a bill focused on one thing. I suspect this is going to turn into a big omnibus bill where everybody's going to be given.
Well, no, Jay, it's actually called a big, beautiful bill is what I've heard.
Or a big, beautiful. Yeah. I mean, everybody's going to have to get what they want in order to get enough votes to pass this. Now, is anybody, I mean, it's a big game of chicken. Is anybody really going to be willing to risk a default on the debt not to pass this bill?
Well, it's such a joke to me because like this is politics at its worst. Like it's one of those like the debt ceiling is an issue that needs to be passed because of past things that happened, right? Like money that's already been committed and money that's basically
money that's
been
already
spent.
allocated. It's just
Right.
administrative.
So it's two completely different things. It's politics, and the reason they don't want to get rid of the debt ceiling is basically it's a way for people to get what they want put into bills. It has nothing to do. Like by the time we have to increase the debt ceiling, the damage is already done. What I'm saying is that there's no cause and effect with the two things.
The time to negotiate about debt is when the bills are actually passed, like the spending allocations are made, right? Like you just like the conversation, the negotiation should be about what are we going to agree as a government to spend money on, not like, oh, we agreed to spend money. Now let's decide if we're going to actually pay for it. That just
we're one of the
like
only
a backwards
countries that
way of
does it
doing
too, right? Like we're one of the like most countries, they do this at the time of making the budget, which is when it makes sense. Like I'm going to make the budget and I'm going to decide how much money it takes to spend at the same time.
And we have all this risk. Why do we have this risk? And I think this was a big thing at like the heart of Trump's argument too. It's like, this is ridiculous where it's just the opposing parties decide to put a gun to the other party's head. That's it. We have to pay it. And we're literally going to risk default over politics. And now the backdrop of this is obviously a more important issue. This last quarter came out 40% higher. We went into the red 40% more than we did the prior year. Like astronomical sums of money more. Like it is crazy, right? So 2024, they literally overshot in one quarter by 40%, which was the equivalent of like $300 billion. $100 billion.
I know Jay was like, "Oh,
more.
they freed up $50 billion." It's like, "Oh, that's cute."
Yeah,
like,
they
how
ate
nice.
that up in the equivalent of what was it, 1.5 weeks.
Yeah, exactly.
But keep in mind, most of the spending that the government does, and there are exceptions, things like the interest on our debt. We don't know what the interest on the debt is going to be in December as of today because we don't know how much Treasury bills and bonds that we need to issue between now and then, and at what rate, or what the interest rates are. So there's some things we don't know, but a lot of this is captured in the budget. But that's the other crazy thing that this isn't, I didn't make this part of the conversation, but it should be. We still don't have a fiscal year 2025 budget. Normally, the budget for the fiscal year comes out in calendar year before. So October, November, not when I say normally, it should. Last couple of years it hasn't because we've had the same infighting. But normally by October, November, we should see the budget for the following calendar year. We haven't seen that yet. It could be
We're
March.
spending a budget that hasn't even been created.
Exactly. We don't know how much money we're going to need this year.
Can we talk about this budget reconciliation too? Because I feel like that's all the news. Everyone's talking about budget reconciliation, and I don't know, Jay, if you're prepped to explain what it is, but basically, it's a loophole that you only need 51% of the votes in order to get something passed instead of the traditional way of 60, and it is also, but it's constrained to just budgetary issues. And it was designed to help reduce the debt. Like that was kind of how it was helped to push through things that would reduce debt. But recently, like we've been using to increase it. Like they want to push through like adding more money for border security. They want to push through like spending more money on things too. When historically it was just supposed to be for reducing the debt.
Yeah. So reconciliation is just a way to fast track certain expenditures. Typically, it's stuff that you absolutely need, like debt ceiling type stuff or interest payments, or stuff that's previously been approved. So if you have certain budget items that have been approved for previous years, there's legislation that says we're allowed to spend this, even if we don't have a budget for the following year. It makes it a lot easier. I think we've done reconciliation bills 24 times since in my lifetime. So how old am I? I'm like 80 years old. Since the mid 1970s, I think we've done 24 of these reconciliation bills. So like every other year. So it's not uncommon. And we did another one 3 weeks ago, that basically allowed us to push things out for, I don't know when the new date is, but at some point in the next few weeks, we're going to have to either figure out this budget thing, which I think is highly unlikely, or we're going to need to push it out again. And so right now, I feel like what we've seen over the last couple of years, a couple of years ago, even let's say a decade ago, 2 decades ago, I remember when like we had these budget fights and these reconciliation bills and debt ceiling stuff, and it was a big deal like a month before. And Congress would come in and they'd spend a month negotiating. Now it's like 3 days before like it expires or we're at risk of default. That's when Congress says, okay, we've got to do something about it. And they kind of just like,
well, they know they have this extraordinary measures in the back pocket too, right? So like, I feel like it's one of those procrastination things that happened last time in 2023, where we had already like gone past the date, but we were doing these extraordinary measures, and it wasn't until the week before we were going to completely run out of money, and they're going to have to stop paying people and like not have any, like they were going to have to like cut like federal spending on like military and like things like that. That all of a sudden that's when it got done. So I like, if I'm Janet Yellen, can't she just go in and just be, like the same thing that I do with my wife, where I'm like, okay, dinner's at 7:15 when it's really at 7:30. Like we're gonna run out of money in March, but really it's not till June.
I wish. Yeah. I don't know. I'm with you on this, Kyle. I just think it's just politics at its absolute worst, and whatever they got to do to stop having this conversation every year, I support.
Well, let's go through what all of a sudden. So they've talked about what this bill has to consist of. So obviously, it has to figure out the debt ceiling, right? That's what the meat of it's supposed to be. But it's become like that's no longer what we're talking about. It's become what's all going to go into this big, beautiful bill, as they say it. And it might end up being 2 bills now, they're saying, because they're, the first time they tried to put everything in one bill, it didn't really go very well. But they want to get 4 things in. They want to boost border security. So they want a couple $100 billion for that or something. They want to clamp down on immigrants. So that was weird how they phrased that. I didn't know if that meant they were for like deportations or like just population control or what. They want to extend the 2017 tax cuts. I got no problem with that. Let's keep that one there. And they also want to raise fossil fuel production. So all of a sudden, these things are all being lumped in to this bill about the debt ceiling, just because they are high priorities for the Trump campaign. It has nothing to really to do.
Here's the funny thing. As of, I'm looking at the timestamp on this article, as of 7 hours ago, because I thought I had heard that something came out about this today, Speaker of the House, Johnson, 7 hours ago, basically said he's no longer wed to having the debt limit as part of this big, beautiful bill. He's now okay with passing all these other things without passing a debt ceiling increase, which could...
Why don't we do the debt ceiling, pass the debt ceiling first, and then we can worry about these things?
Because I suspect that they know that Democrats will basically be unwilling to pass the debt ceiling increase. And there are probably at least a couple MAGA Republicans in Congress, in the House, that are going to be unwilling to pass a big debt ceiling increase. And so it could be really hard to pass the debt ceiling increase without a lot of negotiation. And I think Republicans just want to be able to pass this big, beautiful bill without much negotiation, just by getting their 51% of the votes and not having to worry about Democrats. For the debt ceiling part, they're going to have to deal with Democrats because there's going to be a couple of Republicans that aren't going to be on board. I have to wonder if the Democrats get cut out of the big, beautiful bill and the Republicans pass that without basically giving any concessions to Democrats, if Democrats are going to turn around and then basically say, well, you didn't deal with us and negotiate with us on the big, beautiful bill. We're not going to negotiate with you on reconciliation, which obviously is a mistake because it's a game of chicken that can cost us our currency sovereignty. But who knows? I wouldn't be surprised if we see either or both sides kind of resort to those kinds of threats.
I think we said this before. There's obviously a hierarchy of like federal spending, and I think defaulting on our obligations for loans and like our credit rating is pretty far down the list.
They would just stop paying people everything else.
Yeah, like entitlements and stuff like for Medicare and stuff. It's probably right in around there. So there's a lot of things like we're going to be like people's salaries and things are going to be they're going to be taking a hit before I think any of those things happen. But according to that last handshake agreement that got that 1.5 trillion, they need to have 2.5 trillion in net cuts to spending as part of this reconciliation package. So we'll see how good their handshakes are in the upcoming times. And I have a feeling, as Jay said, come May or June, we'll probably be talking about this again. Any final thoughts, AJ?
Just nothing new. I mean, you package it a different way, different party, different everything else. But I mean, this has just been replayed over and over and over again. And every time you do, it's a new issue and there's new things driving it. But I mean, it's almost, it's literally to the point like I would be shocked if we weren't having this discussion, right? Like that would actually be very surprising if we weren't in the middle of this. That would be surprising. So I think this is it's scare tactics used by politicians, and they're just doing their political, maneuvers, everything else. But this is something that's just played out over and over again, and it's getting old, I think, for everybody.
It'll be interesting because a lot of Trump's big the Republicans who are against him, especially the ones who voted to impeach him and things like that, most of them are gone, right? They're not here again this time. But at the same time, he's also he's termed out, so it'll be interesting how some of these Republican senators how they react to that, whether any of them are going to kind of take a stand on him, knowing he's not going to be coming back for another term, or if they're all just going to fall in line and kind of toe the line. So
just because he doesn't come back doesn't mean, though, he can't ruin their ability to get reelected.
True. Yeah, if they're up for midterms. Yeah. All right. That was just as boring as I thought it would be. So let's move on to a little bit more interesting. At the beginning of the year, we did our predictions episode, and a few people pointed out that we were noticeably sparse on the single family related predictions. Here on the show, we have 3 commercial real estate investors and some other guy, I forget his name, also. So naturally, we tend to skew towards topics that affect that space. Well, this week, we're going to try and make up for our shortcomings. Since we're not single-family experts, we thought we'd go out and tap the best in the business. So, Dave, We're hoping you could shed some light on the state of the single family market in 2025 and maybe fill in those gaps that we left out in our predictions episode.
Up or down? That's all we want to know. Up or down?
What's that? Up or down?
That's all we want to know.
I think we're going to be flat.
Well, and Jay, the answer is quite different for most people versus you living in Florida.
You'll be down for sure.
That's a resounding down.
Down.
You're going
No
down.
doubt.
Uh-huh.
No doubt.
But I think we'll get to this, but I would guess that we'll probably be flat-ish, especially in real terms, maybe a little bit up in nominal terms. But let's just lay the scene a little bit. I mean, commercial and residential have both sort of been in what I would say is a recession, right? Transaction volume is deeply down, inventory is down, and it's just been a stuck, really slow market. The difference in residential is that prices have proven relatively resilient because demand in the single family market isn't as volatile as I would say as it is in most commercial markets. And so I actually think we're at a really interesting point in the residential housing market where we're sort of transitioning from a housing recession to my prediction is that it's going to be a very long, slow recovery. And I don't think this is going to be a fun recovery where things are really starting to go gangbusters, or probably not going to be anywhere near the size or scope of the expansion of the last single family run. But I do think that we are close to a bottom in terms of transaction volume, if not already at the bottom.
So
I do expect.
Can I interrupt you there for a second?
Yeah, please.
Because I think maybe this is just how you're defining it, but it's funny because I don't think I've ever thought in terms of where we are right now as being a housing recession. And are you just talking about transaction volume being in a recession? Because that I can see, but like I find it hard pressed to call what we're in right now a housing recession. Do you disagree?
Well, if you think about total transaction volume and total just dollars being exchanged in the residential market, it's a fraction of what it was 2 years ago. And so, I mean, it's sort of, I don't know, I'm sort of just making up the terminology here. But from 2022 to now, transaction volume is down 50%. We're down about 30% over the long-term average. And so, I mean, if you asked anyone who's a real estate agent or a loan officer, if we're in like a significant housing downturn, they would say yes. Even if housing prices have been up in real terms over the last couple of years, I don't think it's a crash or a correction, but I think just the market is so slow. It's certainly not an expansion. Like I don't know what else you would call it.
And so in your mind, does an expansion basically mean just increase in transaction volume? What if we saw that, but without an increase in prices? Is that out of the recession, or do we need to see an increase in prices also? And I know these are made up terms. Nobody has a formal definition of recession in this space. So I'm just trying to get an idea of what you're thinking.
I think mostly in terms right now of transaction volume, just because I think that's what we need to get to a healthier housing market. What's going on in single family right now is just not a good market for investors or just for homeowners and for like American society, in my opinion, where it's just super unaffordable. People who are starting families aren't able to buy family style homes. It's just a bad situation. And for the housing market to regain some health, we need to see inventory and transaction volume rebound. And so like, to me, that's the biggest issue in single family homes. That might in turn slow down appreciation, which may be what you're getting at. But to me, I think that's, I do think prices will still probably go up a little bit, but it's going to be much, much slower than it was in the last, let's say from 2013 to 2022.
Yeah, I think what scares me is that the thing that would be the most obvious, and certainly not the only one, there are plenty of others, but the most obvious catalyst for an increase in transaction volume would be a broader economic recession where people are losing their jobs and their hours are getting cut and they can't pay their mortgages and the bank's coming after them. And now they either have to desperately sell or they get foreclosed on. And now we have all these houses flooding the market. And that seems like a situation where, yeah, we see a lot of transaction volume, but it's probably not going to lead to prices being stable or going up.
Well, also just interest rates, right? Like we saw it last year when there was that brief time. It was like 1 month where where the mortgage rates went down close to 6. It actually like touched 6, and like transactions were up 10% that month. And so, like, I think which more broadly, Jay, then your question is, okay, why would interest rates come down? That might be getting to your end game there. But even if we see, like, I don't see a reason, like, as we speak, what is it, 4.8, 10-year treasuries at 4.8 or something right around there. I don't see why we are that high. Like, it's fears of future inflation coming and ruining everything. And to me, if those fears don't come to fruition, and we're 4 or 5 months into this, and everyone's like, well, actually, inflation's down, and job losses, we haven't gone above 5% and everything. Like, I feel like that 10-year treasury could come way down. Like we were at 4.25 not that long ago, like a month and a bit ago. Like, so, like, if we can get that down and we can get a more stable market, maybe even those spreads like that we're seeing, because we're at almost historically high spreads on the 10-year treasury to mortgage rates. Those spreads can come down and we can get that magic, it seems like 6% mortgages. Like, I feel like we would see a real significant bump.
It would be short term. I mean, we're at short now, what, 7 million homes in the United States? And every year we're getting even more behind because nobody's building. So even interest rates coming, that is yes, I think that would boost, but this is short term, smaller problems. You're not getting a vibrant market back when we have 8% interest rates, and homes aren't losing values because there's so much demand that we get 100 basis point drop and everybody scrambles to get whatever they can. I mean, that's a short-term fix. You drop interest rates and all of a sudden the housing market spikes and inventory's gone immediately, just gone. And we're right back to where we were.
Yeah, I agree. I have a hard time imagining prices going down pretty significantly in any time. Because, like, Jay, you're saying maybe there's a recession, it's a job loss recession, and maybe people lose their homes, but I would argue that we're in a much better position for people to hold on to their homes. Homeowner equity in the US is at all-time highs by like a huge margin. Banks have gotten a lot smarter about how they deal with people. Like, you look at what's going on, and yes, there was government intervention for, forbearance and stuff. But even since forbearance ended, if you look at mortgage delinquencies, they're at almost all-time lows right now. And the quality of the credit in the New York Fed puts out really good data on this, is really, really high. And so you'd have to see a really dramatic change in the labor market for a sustained period of time.
But even if you saw that, interest rates would drop. So you would everybody would buy. If you drove unemployment up to 6%, and all of a sudden now the Fed has a real reason to drop rates to get money moving, that housing market is going to explode. Because you're talking, okay, 3% of the market, but you just opened up affordability to 20% of the people.
Yep. Yeah, absolutely. There's like, I think something like 103 million American households currently priced out of the market right now. So if you start to improve affordability at all, I think you see people jump back in. I actually think right now is probably going to be one of the weaker points for price growth, because people are going to be waiting for something to happen one way or another, rates to drop or something to improve. And there's just a lot of short-term fear or anticipation that rates are going to go down. So we might see some short-term loss. But
well, as far as real estate investors are concerned too, I read a really good article where it was talking about, like, these people are waiting for foreclosures, right? Oh, foreclosures, we're going to see this, we're going to do that. But if you look at, there's a couple good stats about household mortgage debt as a percent of GDP. If you look at that chart, actually I could throw that up real quick. Like, we are nowhere near where it was back in like 2008 when we had issues. Or the other one was mortgage originations by credit score, where, like, if you look at that, like, the mortgages are like, we're actually at a pretty good spot right now as far as mortgages are concerned. So, like, when you talk about like foreclosures happening, like, I just want to get that off of everyone's mind. We're not going to see some massive foreclosure based like, it's not going to be a real estate recession based off that.
Well, they couldn't, if it went to foreclosure, it would have to be because they couldn't sell it. But the problem is you'd have to lose all this equity. So people can sell it. If you sell it at a discount right now, you got $200,000 of equity in your home and you take off $50,000 of it, that house is going to go like that. And you're walking away with $150,000.
Yeah, it would take so much for people to be under, for most, unless you bought in the second half of 2022, like, or later, the chance of you being underwater in your mortgage are so small, even if there's a recession. The second thing is, like, banks have gotten so much better at dealing with this. You know how many hedge funds and PE firms they would just call to take these things off their books before it ever got to the point where they were selling for a loss? Like, all Wall Street has gotten much wiser to the value of residential real estate, and they would be happy to buy those things at a discount because they can now operate them, unlike banks, and they probably just sell them off. Like, they're not going to come down to someone like me who's going to go bid on them in the courthouse steps. Not that I would ever do that, but someone theoretically like me.
And I, just to play devil's advocate here, because Dave, you know, I was on your show. It just got released last week. Yeah. And we talked about this, and I agree with you. I think we're in for several years of flat single family home values. But from a data standpoint, it's important to realize that even though we can still get flat home prices for the next 5 years, even 10 years, that doesn't change the fact that we are in, I hate to use the term bubble because bubble implies it has to burst. It doesn't necessarily have to burst, but we're definitely in a point where housing is historically overpriced. And the way we see that is that there's this trend line of inflation from 1900 through like 2013, where inflation kind of goes up in a straight line for 113 years. And if you look at real estate value increases, with the exception of 2008, where it spiked, but then it came crashing back down, basically housing increase and inflation increase over 113 years were basically in lockstep. And so over the last 10 years or so, we've seen that housing prices get out of lockstep again and go way, way above the trend line, even further above it than 2008. So eventually we assume that those two lines are going to converge again, that real estate will come back to the trend line, but that doesn't mean prices have to crash for that to happen. Prices could just stay flat for 10 years while inflation kind of catches up. And so, I think it's not.
Also, there's lots of countries that it never went back. That's the norm. The norm is not to go back. The norm is actually for it to stay at this thing. If you look at all developed countries in the world, the United States, the only reason that we were so different was because we had such a surplus of homes due to home builders. So if you look at our inability due to regulation and cost to develop homes like we used to, then we will act more like those countries that were limited. And if that's the case, you're not going back down to the trend line.
I would argue there's one other huge factor, and that's the fact that we get very cheap loans and very good loans, long-term fixed rate loans on houses. And so our housing market is a whole lot more efficient than the housing markets in other countries. In other countries, the average person probably doesn't buy a house when things are overvalued because they can't get a good loan. They need a big down payment. In the US, everybody can buy a house, or up until a few years ago, everybody could buy a house in theory. And so it became a really efficient market, and basically it was a way to store wealth. So you may be right.
We're seeing the downside of these long-term fixed rates too, where like no one wants to get rid of it, right? Like Canada didn't have the same issues because the longest loan you could get was basically 5 years locked in, and then you're refining that into something else. Most of them are floating rates, so like you're always fluid. You're always going to have the same kind of market: high interest rates, low interest rates. You're going to have very few fluctuations just because people are having to get in and out of these loans pretty frequently. Someone could have I know it's very rare. What's the average? 7 or 8 years or something, but technically someone could hold on to this loan for 15, 20, 30 years if they want.
The best example of that, Kyle, is California. So California is regulated like crazy. You can't even build a home. But 2, people don't sell it because of the taxes. So they can hold on to it and they keep their tax basis at a low amount. So it's like generational. Like people are in with their parents, everything else. They've got all this equity in it. But if they sold it, it's going to be worth millions more. They're going to have to, their tax is going to be crazy. So people hold on to homes. And I think in the United States, you're going to see similar to that. But if you want lower housing prices, you have to move. You don't like, housing in certain areas may come down a little, but really this is going to be an already set up thing.
I'm in Florida. I don't need to move. I just need to stay put.
Just wait till your house gets wiped out, and then take the insurance and move somewhere else.
Well, I want to go back to something you said, Jay, about sort of returning to the long-term average of affordability. And I do think that's sort of like the $1 million question here, right? It's like there's this assumption by a lot of people that it needs to go back to some semblance of historical average. And as AJ said, if you look at other countries, that hasn't happened. And I also just look at other parts of American society and the economy that have changed. Like you could say that about college, right? Like everyone was like, oh, college tuition has risen so much. Oh, something's going to change. It hasn't changed at all. Look at daycare, childcare in the United States. These are like highly regulated, limited supply types of things that people really value, and that there's this just sort of inelastic demand for. People just want it. They need it, And so I don't know. I don't hope I'm right. Like I actually, even though I'm an investor, I own assets. I do think it's would be better if affordability went back. I have a really hard time thinking logistically about what sequence of events is going to
7 million
lead to
homes. Dave, how are we going to get 7 million homes on the market? At the end of the day, it's not a demand problem. It's a supply problem.
Well, and at what point are buyers maxed out? Because I don't know about but most people, but we have when we do rentals, right? We have an income qualifier that it has to be 30%. That's the max that their burden can be, is 30% of their income. And the average in America for homeowner costs for buying a home right now is over 40. It's 41 or something percent. So it's much more expensive to own a home than to rent right now. So at what point, what number, 41 is pretty high. Think about the money that you bring in. If you're using 41% of it just for your housing, at what point does that get unsustainable? We keep ticking up. Now it came down from last year, but in the general trend, as it keeps going up, at some point we have to hit a ceiling where people just can't afford it.
Well, we have. And so what do people do? They move. That's what's happening. So you migrate to areas that you can afford. It's we're not seeing housing isn't going to go down in California. It's not going to go down in New York. Frankly, it might not even go down in Texas, but it is more affordable in Texas. So if I want that, people are just having to move. And this has been a major cause of migration since 2015. And those elements aren't changing. So I think you're going to just see these areas that have lower housing costs. People that are eligible to buy homes are looking at it saying it's $3 million where I live, $400,000. How much of an income cut can I take to buy a home, which is the number one source of wealth for me? And people are going to move, and they have, and I think they'll continue to.
I agree with you. I think affordability, in my personal investing, it's probably the most important thesis I operate on for single family or residential investing is people are going to move towards affordability. I think that, I buy in the Midwest. I think that those types of places are going to see a resurgence in maybe not this year or next year, but over time, especially, remote work goes up and down, but there is far more remote work than there was before. And some semblance of that is going to stay. And also businesses move to more affordable places. Once they get too expensive, employers are going to move to Ohio. You see it already. They're moving to Ohio because they give tax incentives and they can pay people less and still give them a better quality of life by moving to those places. So those are slow moving things. It could be 3 years, 5 years, 10 years, but I agree. I just think a lot of people are going to look at living in a place like California and say it's just not worth it, and move somewhere else where they can have more money.
Well, they're already saying that, but I guess the issue is everyone was moving to Texas and Florida, And now Texas and Florida are having their own issues with their taxes and insurance issues and things like that. So like, I don't know if it's kind of just a whack-a-mole thing where people are going to keep moving and then there's going to be issues there and, climate issues and taxes and all these different things. It's kind of tough to wrap your head and stay ahead of as a real estate investor, especially when we're looking, we're trying to hold these investments for potentially 10 years.
Hey, Dave, for a lot of our listeners who are investors, this is a good conversation, but it's not necessarily actionable. What's the playbook for single family real estate investors right now, whether you're flipping houses or doing BRRRRs or long-term rentals, whatever it is?
Yeah, I mean, the way I categorize this, I think we're sort of entering this new era of residential investing that is honestly just similar to what it was before 2013, pre-bubble, which is that you need to buy with some business plan to create upside. The era of like when you could just buy something and it was going to cash flow immediately and you were going to get these enormous tailwinds of appreciation, it's probably not coming back for any time in the immediate future.
So we should start by like reading a book or two first. Is that what you're saying?
Yeah, I think that might, I can recommend a few to you, but I think that's the truth. And so I personally still like residential because I think there's a very good case based on this entire affordability thesis that rents are going to go up long term because rents, it is cheaper to rent than it is to buy. And I think that's going to create a lot of demand, particularly in single families for rentals, especially in good school districts at the higher end of the sort of spectrum of luxury. And so that's sort of what I look for. I think we have to go back to an era where if you're buying residential, you are assuming you're going to hold it to 5 to 10 years. Like this idea you can hold it for 3 and make a profit is probably not wise. But value add investing, BRRRR, flipping still works very well. If you can find places with long-term rent growth, I think that still works really well. Zoning, there's a lot of zoning upside right now if you're willing to add units or to develop something. So I think it's just being a business person. Like, I think the days where you could be super passive about it aren't as appealing. Like you can, like I've bought deals in the last year that are 1% rules on market. They're fine. They're pretty good. They're not amazing. If you really want to hit home runs, you're going to need to be pretty active.
Yeah, and that kind of resonates with me. I've been saying for a couple of years that we have to get back to the basics, and people need to understand how this industry works, how this business works. Treat your real estate investing the way you would treat any other business. It's not a hobby. It's not different than any other business. We have profits, we have losses, we have inventory, we have cash flow management, we have all of these things that any other business has. And if you don't understand how a business works, you're not going to be successful in real estate.
Yeah, and I think what's required is a reset of expectations. And listen, BiggerPockets has had a big role in this and like setting people's expectations like, oh, you could retire in 2 to 3 years or 5 years or whatever. And for a very brief, like very special moment in time, that was true. I don't think that is true necessarily. I actually did some math. And I think for the average person, you can still retire with real estate 8, 12, 15 years. Like that is still possible, but you're going to have to work for it.
If you got in 2015 and you got out in 2023, it would be perfect.
Yeah, it's perfect. Yeah. If you had that magic crystal ball, good for you. But it's not like real estate wasn't a good business in the 80s or in the 90s. Like this is the oldest business there is. It's been a successful business for truly centuries. And it's still going to be a good business, even though we're no longer in sort of this Goldilocks, everything is perfect era that we were for a while. And that's okay. I think it's just going to be more people who are super committed to the idea of real estate. And they should be, because I genuinely still believe it's the best asset class to pursue financial independence and to better your life. But I think we just need to accept that this isn't a get rich quick scheme. It never really was, but it's not, even though there was this brief moment where it felt like it was, we just need to come to terms with 10 to 15 years, which is still incredible. That's like a third of a normal US career.
Yeah. I mean, the reality is that real estate works in cycles, and where we are right now is a normal part of the cycle. The difference is normally this part of the cycle lasts for a couple months. We get to a top, we see slow transaction volume, and then we see a slowing or I'm sorry, an increase in transaction volume. We see price discovery, and maybe prices go up, maybe they go down, whatever. We've kind of been stuck in this part of the cycle thanks to a lot of money printing and a lot of monetary policy for several years now. And so it's not like this is completely new and uncharted territory. It's just we're in this previously charted territory for much longer than we normally are, and it's not a fun part of the cycle to be in for a long period of time because there's a lot of uncertainty.
Well, and I think people got to realize that, and I've been saying this for a long time, I do not know that we will ever return back to interest rates that we were. I don't, that we had a 10-year period of time that was so unique and arguably shouldn't have even happened. And that expectation that we would even get to that point makes no sense because that was the only time it ever happened. So that's not a normal thing. And I think
but now it's in the playbook though. Now it's
it may be in the playbook, but that doesn't mean it'll happen. And so I think that if you sit there and are waiting for interest rates to get down to that level to play the game.
Oh, I'm not saying you should be sitting waiting for that.
Or expecting it to happen. I think if you're expecting it to happen, you should be very, very nervous.
The government used it as in their playbook. They know it's in their bag of tricks now. And the world didn't explode. It actually went pretty well.
No, it only went well, though, because we lost $16 trillion. The only reason that we could drop interest rates to 3% is the economy lost $16 trillion. If we don't lose $16 trillion and you have interest rates at the level they are, you have inflation. So
but how long did that take to come to fruition though? And how many terms of presidents and Fed chairs before any of that had issues? If you're the politicians who were in office when they pulled out that playbook and it happened, things were pretty good. Everyone was pretty happy. They got reelected. Everything went great. I just don't see them never pulling that out of their bag of tricks again.
What I'm saying is you pull that out and hyperinflation or inflation takes hold, you have to shut it down immediately. The only reason we didn't have inflation was because we lost $16 trillion. You were filling in this ginormous vacuum of money. And the reason they didn't use it before was because we didn't lose $16 trillion. So they literally couldn't. And if you look back, even when the last time that we did lower interest rates and we did do those things, once again, we know when that was. Look back at the chart, the 50s. Now, why in the world in the 50s did we get interest rates that were that low? Because we had the Great Depression. So unless advent of 2008 and the 1940s and 50s of the Great Depression, interest rates have never been that low because there was no way you could do it without causing inflation.
Yeah, but I guess so. Then go back to like Jay's got the chart up here of the Fed funds rate. Like,
and just really quick, just to summarize this chart for the people that aren't watching. Basically, what we see, the federal funds rate goes in basically 2-decade cycles. So 50s and 60s, we were really low. We were under 5%. 70s and 80s, we were pretty high. We were between 5 and 20%. 90s and 2000s, things were actually pretty in the middle. We were somewhere between 5 and 8% for much of the 90s and 2000s. And then after the Great Recession, we've been down near zero for most of that time until about 2 years ago. And so that's what this chart's showing. Sorry.
And so, but I guess if you point to, yes, of course, we know why we dropped it to zero in 2020 or 2008. But why did we keep it at zero all the way through 2015, 2016 there? Like we didn't have to. It's just things were going great. And everyone was like, why are we going to do this?
No, actually we did. The money defaulting didn't end until 2015 to 18. The money lost. So that $16 trillion didn't happen in one blink of an eye. It took roughly 5 to 6 years to get rid of all the debt, everything else like that associated with it. And we had QE going on. So a $16 trillion hole developed it only happened. And look what happened right after 2015. They started to raise interest rates.
And then they dropped them again, I guess. And because Trump came and he got pissed off too. And I guess that's the big difference that I see too, is if you want to go back to like previous years and going back decades and decades in the 70s and 80s and stuff like this, like we didn't have that much debt back then. Like our debt to GDP, like I still remember when we were below 100 and everyone's like, oh, we can't go above 100. And what are we at now? Like 130 or 100? Like I don't even know what we're at now, because people just all of a sudden figured out it doesn't matter anymore. That
theoretically mean you could lower interest rates lower. The more debt you have actually creates a cause effect where interest rates can't go lower. It's inverse.
So the point I was going to make is that like our interest payments last year were over $1 trillion. And just last year, by raising rates, the difference between last year and the year before was a difference of like a couple $100 billion. So
but that sucks, but it doesn't matter. Just because they want cheaper money doesn't mean you can have it. So just because the government said, oops, we took out a lot of
debt. You can have it, just not without inflation. And it's just, how long is that inflation going to come, and how bad is the inflation? Like we've decided all of a sudden that like 2% is this target inflation. We have to get to 2%. Why? Who made up this 2%? It was some guy in New Zealand or something who came up with it, with the 2% number as our target. And and one of the biggest mistakes that Powell and them made was setting a fixed 2%. Like they should have just said, hey, somewhere 2%, between 2 or 3%, that seems to go well, but it's a moving number. Like if we have 3% inflation, but we can have good job stability, good unemployment numbers, and we can have low interest rates where our country doesn't have to pay $1 trillion in interest payments every year. Like why? Like I don't see that as a non possible thing happening.
It's never happened before.
I agree that they're like, if they're wise, they won't do it, but they probably will be tempted to. But I think the part that impacts residential real estate is not necessarily what the Fed does, but what mortgage rates do. And although they are related, I think bond investors and people who buy mortgage-backed securities sort of learned their lesson. Banks took a bath on owning a lot of debt when they were buying in zero interest rate policy. I mean, we saw banks go out of business because the Fed raised rates so quickly. And so I don't think we're going to see this time where we see 10-year yields at 2% again, even if the federal funds rate go down to zero. It's probably maybe they get into 3%, where we'll have mortgage rates at 5%. So like, is there a world where mortgage rates get to 4.5%, 5%? Yeah, maybe. I think in the future. Is there a world where we're back at 3% mortgages? Like, I don't know about that.
Just the moment we have someone who wants to get reelected and there's some like rockiness in the economy going on, those interest rates are going right down. Like if we're in the middle of a term, it's obviously Trump doesn't need to get reelected, but the next, whoever comes in next, and they want to get reelected.
The market doesn't care if the market and the Fed doesn't care if you want to get reelected, if it's going to cause inflation, and if the market doesn't believe in those bonds. It's a president.
I disagree. I think the quote unquote market doesn't understand how interest rates impact inflation. So we can talk about the investor market, but the reality is you can easily convince most Americans that lower rates are better. I mean, Trump basically he certainly didn't win on it, but one of his campaign promises was, I'm going to give you 3% mortgages again. And everybody was super excited.
Yeah, but they're not the ones buying the bonds. The bondholders are the ones that set interest rates because of supply and demand. Those people do care. So if you want lower interest rates, you got to convince all these people to buy them. And you got to convince more people than are selling to do it with investors that will do it. And you also
you got to convince them that we're not going to have higher interest rates in the future, I guess.
But that also depends on the fact that we don't have debt that is so unstable. That's the problem. You have investors and the Fed chair. These are the two people that control interest rates. It's not the president. It's not the public. It's not because the president wants to get reelected or because somebody wants a cheaper 30-year mortgage. That has nothing to do with it.
I totally agree. And it's not convincing ordinary Americans. Bond investors and people who buy MBS are hedge fund managers. They're pension funds. Like, these are sophisticated investors who honestly don't care about politics.
But they are the ones that make it, though. It may be small, but they're the ones that make it.
It's like those people you're talking about. Like, there's also a huge portion of the people who are buying these bonds who they aren't that interest rate sensitive. Like look at what else are you going to buy right now? Are you going to buy more volatile bonds at lower rates right now? Are you going to Germany? Are you going to Japan right now? No, everyone, the best option is America. And it doesn't matter. There's people who just need to buy bonds for their portfolios. Banks, in order to have a charter as a bank, you just have to buy the bonds no matter what level they're at. There's a huge portion of the bond market that just buys bonds regardless of the rates. Yes, there are people who they're going to get in and get out based on what the rates are, but there's a huge portion that just buys based off because they have to. It's not like, oh, all of a sudden, like if the rates move this much, then there's no bid for it. There's always a bid.
There's a bid though, because that demand changes. So they know that there's going to be a bid. It doesn't have to, you're like, all that has to do is there has to be a 5% change in ask. You don't need them to not buy. They can all still buy, but they're going to buy at higher rates. That's the problem. It's not that they don't have to buy at that rate. And if they don't, it goes up.
Right. But what you're saying is that they're not going to buy if it's not the rate that they want. And I'm saying there's a huge portion of the bond market that just buys regardless. It doesn't matter what the rates are.
They're not doing that. And they won't. There's no reason to.
What do you mean they're not doing that?
Rates are going up, Kyle. So the Fed's rates are going down. Interest rates are going up because they're not buying.
What's happening right now, it's not that people are just like the faith in the market or they're not buying or based off of those things. It's just that the projections for forward inflation right now are so high that it's a blip in it. Like we can't use right now. Like a month ago, it was 4.25. Now it's 4.8. It's not like this is an overall trend. This is just a very volatile part of the market right now, and people don't know what to handle it. I'm looking at a longer trend of these interest rates and how they react and what affects them. And yes, it does affect it, but in the long run, I don't see it. It's such a big market that I don't see these people who are so interest rate. Oh, I'm not going to buy it if it's at 4.8, but I am going to buy it if it's at 5.2. I just don't see it being that big of an effect in the long run.
But it's never been like that since 2008. That's how it's always been. That's what I'm saying. We say that, but the market still existed and it never did that. It never did that until the last 10 years. So if we're saying that they're going to act like they've always acted.
So it's so unbelievable that what's happened in the last 10 years, there's a new normal, like everything, like it has changed. Like if you look at all the metrics and look, we thought that the debt ceiling or that the debt to GDP could never go above 100. We blew past that.
And that makes interest rates go up.
We are in an economy right now that relies on cheap debt. Everything relies on cheap debt because so many people have gone out and assumed that it's the new normal of cheap debt. And we will not function as an economy unless we have cheap debt. So if we're going to say, okay, like once interest rates get to a certain point, the economy explodes. It's literally done. So like the whole 15% that we saw, back in the 80s and stuff, like we would literally have no economy if that happened right now. Half the businesses out there would just fold. So like there's a level where we're going to hit a point that it's no longer at that point. And I'm just wondering, like everyone, this whole survive to 25, I feel like people have just been holding on and we're going to see issues somewhere. It's just what's going to be the issue. And then I think the moment that we see one of those big issues pop up, whatever that black swan is, they're hitting the panic button because they know they can.
If there's a hole, I agree, but only if they lose capital. We have to lose capital.
Yeah, I agree. Like AJ, I agree with you because the only time from 2010 to 2022 or whatever is the only time we've ever seen negative real yields in the United States, which it means basically if you took the yield on a 10-year treasury and subtracted inflation from it, bond investors were earning negative money from 2010 to 2022 because there were other attractive asset classes like real estate and the stock market. And if you look now, real estate, I still think it's great for people who are active, but for bond investors, is real estate an attractive asset class? No. The stock market, if you look at, the CAPE index or any of these valuations of the stock market, it's above or near where it was in the .com bubble. So are you think people are going to be fleeing bonds to the stock market like right now, like they were in the 2010s? I just think like people have wised up a little bit to this like like no one knew what ZIRP was, the zero interest rate policy, and people were like, this could last forever. Now we've seen there are negative consequences of it, and yeah, like they might do it again, but I don't think people are going to like fall hook, line, and sinker for this again and be like, oh, I'll take negative yields. Like, yeah, like it just seems, yeah, they're going to remember.
There's only
at least in
one
the next
reason.
10 years.
There's only one reason why we were able to sell bonds in 2020 and 2021 at 0% interest. And that's because every other country on the planet had lower interest rates. And so they were happy to get zero because their
Which will always
alternative.
be the case, though, in my opinion. That will always be the case.
Well, that assumes we're living in a global economy, which I mean we are, but assuming the global economy is so intricately entwined that there's no shot of seeing a U.S. recession without seeing a recession just
and you also have like banks. Every single bank who provides treasuries is required to make a bid on every single treasury auction. You also have hedge funds, you have mutual funds, you have ETFs. They all are required to have a certain amount of structured investment.
But then I could argue the other side. Then you have China, who we just recorded the largest trade imbalance with them in history. Basically, we bought $1 trillion from them last year, or we had a negative balance of $1 trillion, which means we handed them $1 trillion in cash that they need to do something with. They need to cash in those US dollars for something. What do? They turn around and they buy our bonds. If we reduce that deficit by tariffs, by onshoring manufacturing, which I'm not saying these things are necessarily bad, but the things that we're talking about doing are likely going to reduce the trade deficit. And now we have foreign countries that don't need to redeem their U.S. currency for treasury bonds. And now we have pressures in the other direction. So,
well,
I mean, there's
of
so many
course
things.
that would happen, but like, is that going to happen?
That period that we had was meant to save us from depressions. That zero interest rates is never at 3% was never meant to be a
but
normal.
we're to the point where it's like we can't have a recession. Like we have this opinion now.
No, we actually have more ability to have a recession than we did 5 years ago because we can lower interest rates. If you have 0% interest rates and we go into a recession, we're in big trouble.
I agree, but what I'm saying is that's like we're now of the opinion at the Fed and policymakers that like recessions aren't a normal thing. We have to avoid recessions at all costs. So if we see a recession coming on, like that's like panic in the streets. We have to do everything I can. And in my opinion, they've shown the playbook. They know what to do. And I agree, like keeping interest rates now, they have somewhere to drop it, and that's just what they're going to do. They're going to.
And I disagree with you, AJ, on we're in a good position for a recession, because if you think about it, yeah, 10% of the population, 15% of the population would be thrilled if we had a recession and lowered interest rates. 85% of the population isn't going to be benefited by 0% interest rates. 85% of the population wants to figure out how to put food on the table. They don't care if they can now buy a house at 3% mortgages or buy a car.
No, we're not in a good position. The Fed is to do something. That's all. They have ability to. At zero, they didn't have ability to do anything. So it's not that the United States is in a good position. Just the Fed is with tools.
Well, on QE too, like they can always turn that on. Like that's apparently that has no ill effects, right?
I love how we said this was going to be the fun part of the conversation. Now we're just arguing about quantitative easing and negative real yields.
I went in a deep rabbit hole on a multiple of Fed spend or government deficit on Fed spending that was actually quite amazing, and how that multiple yields in the economy from 2 to 3% to all the way to 4%, depending how the government deploys it. That multiple of creation. Absolutely fascinating.
And anybody that's still listening is probably not very much fun at parties, but I would love to hang out with you.
When we're tagging this episode, we probably have to do act like it's 3 topics, where we're going to do the housing, and then at some point in the middle there, we just got to shift and make it a new topic so people can get past it. All right. Do we need to harp on this anymore? Let's actually, you know what, Dave, why don't you wrap up the housing? Make a final point on this, because we kind of got a little off topic there. But
yeah, I'll just say, like, I believe still in residential real estate. I think it's going to be what it traditionally was, which is a stable really good risk-adjusted return for investors. We're probably not going to see the really sexy things that we saw 10 years ago. You're not going to be able to do perfect burrs all the time. But if you are a long-term patient investor, residential real estate is still a fantastic asset class. I'm still investing in it. And I still think anyone who's willing to sort of have the right perspective and expectations can still do great in residential.
If you're buying for cash flow, right? That's the thing. Don't assume appreciation in the short term, I guess is the thing. I gotta.
Yeah, I think, the way I bucket it is like, you need to have these upside categories. Like the way I buy is I buy at least break even cash flow, right? Like, and I'm not talking about the social media cash flow where it's like just your mortgage payment. I mean like real cash flow. And then I look for upside, which is like, can you increase your zoning? Are rents likely to go up? Can you do value add? And market appreciation in some places is, I think, a legitimate bet if the fundamentals are strong. But you have to recognize that that's like a bet, and you need to like really have a property that you can hold on to for a long time, which does come down to having adequate cash flow.
On a long-term bet too, right? Not a like, okay, I'm going to see 20% this year in Miami.
Right. Yeah. Or it's like, oh, this neighborhood's turning around. I'll buy it for 2 years. It's like, sometimes it takes 20.
I got a question for you. I just thought of, Dave. So you seem like you've moved around a bunch. So if you were moving right now, would you rent or would you buy something?
Well, it's funny. I'm actually thinking about this right now because I just moved to Seattle and it's stupidly expensive to live here, and the housing market's crazy. So I was gonna rent, and then your favorite and my favorite BiggerPockets personality, James Daynard's helping me do a live-in flip. So I'm doing sort of a hybrid because it allows me to sort of do the value add to get some equity into the property.
It's probably the same level of the last flip you did before, which is like 8 million. Is that what you're looking at? $8 million flip?
Me? James. Yeah, right. Yeah. I'm living on the beach in Newport. Yeah. No, not quite.
Cool. All right.
But yeah, if I was just, that's my specific situation. But I think for a lot of people, renting does make more sense.
Yeah, that's what we've talked about. That if we were to try and relocate or move right now, we would probably just rent, or we just wait till Florida the prices get cut in half, because that's coming, right, Jay?
I think.
Well, what I was thinking about doing when I was looking at rentals was to try and negotiate like a multi-year rental with like a fixed increase. Like, hey, I'll live here for 3 years. You can raise it the same as the CPI every year. I don't know if that would work, but that was sort of my hope to negotiate that
with a sublease provision too.
Yeah, it's like a sports contract, Kyle. I want a 3-year contract with a 2-year player opt out.
The option on the side, and also the outs whenever you can. And
yeah, exactly.
All right. Any other thoughts, Jay? Hey, Jay, or can we wrap this thing up?
Long time ago.
Was that a comment on how long things are taking, even though we had to listen to you explain the debt ceiling going back in history to 1930?
I'm sick and not drunk. It's a bad combination.
Okay. Well, apparently I'm the only one that's drunk here. Dave might be with me.
No, I'm having a good time.
We always know these discussions aren't AJ's fault, because AJ's he's got no excuses. All right. I'm going to go through this real quick because this seemed like an interesting topic when I was doing it, but it doesn't seem that interesting now. Top 10 hottest housing markets as determined by Zillow. We talked a little bit about how some markets.
If you're a subscriber to DRE Daily, our daily economics newsletter, you already know this information.
Well, I'm just trying to get more people to subscribe, Jay. But I appreciate you pointing that out. I thought it was super interesting because some of these you wouldn't really expect. So Zillow isn't just based off of home value growth forecasts or stuff like that. They factor in home value forecasts, but they also factor in jobs per new home permitted, their value index, stuff like that. So it's not just like a cut and dry number. So you can look at a couple different things. Go check them out in their Zillow Media Room. But number 10, Salt Lake City, Utah. Number 9, Richmond, Virginia. Number 8, Kansas City. Number 7, Charlotte, always on the list. 5, I skipped 6. 6, St. Louis, Missouri. Number 5, Philadelphia. It's about time Philadelphia made it on the list there. Number 4, bumping up 15 spots. So I don't know if people want to take a look at this, but Hartford, Connecticut, their home value growth forecast is 4.2%, which is looks like it's the highest on the list that I see right here. Then Providence, Rhode Island, Indianapolis, Indiana, and then finally, number 1, Buffalo, New York.
2 years running.
Yeah.
I give Ashley care all the time about living up in Buffalo, New York, living out in the middle of nowhere, and Buffalo, New York pops in at number 1 on the hottest housing market forecast.
For the second year in a row.
She's laughing all the way to the bank, Kyle.
Yeah, exactly. But
but 3% growth on a $260,000 house is not exactly the most exciting thing in the world.
Well, Dave's looking at this. It actually has the value index of all the different houses, and Buffalo is the lowest on all the lists. It's the lowest. So yeah, that home appreciation.
That just means Ashley can buy more.
Yeah, Salt Lake City's up there with 543,000. But one thing that we did that you will notice on this is all of these home values growth forecasts, they all are positive. I think the lowest is 1.9% for all these markets. So something to look into, but obviously you want some of that job growth too if you're going to invest, one of the major things. All right. Jay's favorite segment. This is Jay's new pet project. It used to be just something we threw at the end of an episode where I threw out these never have I evers or would you rathers or stuff like that. And now Jay, I think he's found some website with hypothetical situations on it, and he spends an hour a day going through it. Because every episode now I have a list of 6 of these hypothetical situations, and he's like, do this one, do that one. And Jay, I'm not going to do anything that has Panda Express in it. Okay. Stop suggesting Panda Express. But I will do some of these other ones. And Jay, I'm not going to do the one that kills my dog, by the way. You put one in here where I have to kill my dog. I'm not doing a hypothetical situation where I got to kill my dog.
Well, that can be your answer. I'm not going to kill my dog. I'm sorry if it's a difficult decision for you.
Okay. Well, all right, fine, Jay. Let's see how the crowd reacts to this one. $2 million, you get $2 million, but for every $2 million you take, your dog or your pet, whoever your favorite pet is, if you're one of those weird cat people, lives one less year. So $2 million for one less year. So my last dog lived to 11. If I take $2 million, he would live to 10. How many years are you taking off your pet's life? I'll go with AJ here because I feel like he's the same as me.
How many years?
Yeah. Your favorite pet. I'm not counting your chickens. Those don't count.
He's like, I'd pay that if I could hunt.
He's like, I'm eating one tomorrow.
No years.
The big fluffy.
No years. Teddy bear. My teddy bear. No.
Yeah, your teddy bear that's in all your Instagram.
No, not a minute. He's with me.
I'm taking it, Dave. You pet guy?
0 years. For
0
sure,
years?
0 years. Yeah.
Jay?
The dog I like, 0. The other one,
He could be bought.
Hopefully my wife's not listening to this, but how many years is that dog going to live?
Well, it depends. Are you talking about your little one or your big one?
The little one. Can I just say
the little ones live longer? Those little ones,
they
they last for 14 years. Unfortunately, the big ones are usually 8 to 10.
Well, she's 3 years old, so I'll say 11 years.
22 mil. That's pretty good. Yeah.
I'll pay you to take my cat. If you can get the years out of my cat, I'll pay you.
It's funny. So when we lost our last dog, and he was my boy, that one hit me hard. I didn't even want to get a new dog. So when we got he's my new guys right here. When we got him in the beginning, you could have got some money out of me on this one. But now he's like I'm like the meme of the dad who didn't want the dog, and now the dog does everything. And I don't think I would take any money. I couldn't.
Well, especially because all these hypotheticals Jay has listed out involve huge sums of money. I think there's easier ways to make money than killing your pet in Jay's world.
True. And I don't want to get technical where, the last year of a dog's life, a lot of times they have health problems.
Dave, the market's been pretty soft for a couple of years. So,
Yeah, but I would take some of your other ones easier over here.
Okay. Kyle, pick another one.
Okay. I'll just do one more. You get $10 billion tax-free, but once you take the money, you die within 24 hours. Are you taking it?
No.
AJ, no. Dave, no.
No.
Jay?
I mean, my family gets $1 billion and I die.
10 billion.
10
I'm
billion.
sorry, 10 billion. Yeah. For them, it's kind of a win-win. It's a tough one.
That's a lot of money. Like, that's,
It's a lot. It's a lot of money knowing that the next many generations of my family never have to worry about anything.
yeah, and the 24 hours one's a tough. If you said a month, I feel like I'd take it.
Yeah.
Like-
And the
Like a
original,
month to say goodbye to everyone, set everything up, get that family office set up for my kids, future generations, like take care of some things, and then see ya. I feel like it'd be a pretty good story too. They probably write books about me.
one of you guys mentioned the large sums of money, and what I've had to do is I get these off of Reddit. There's a subreddit on Reddit called Hypothetical Situation, and the monetary values are much smaller. So I increased them to the point where I think it's going to make a more difficult decision. I think that one was $1 billion, and so I increased it to 10 billion.
Yeah, see, this is my dog. There's no way I'm taking $2 million to knock him off. So, cutest dog ever. All right, I think that's enough hypothetical situation. Jay, I'll save the next ones for next week. That's all I got, guys. You want to do some plugs? Start with you. Well, actually, I'll finish with Dave. Dave's a good finisher. AJ, you got any plugs?
Thing on the interest rate. Why interest rates go up even though the Fed is lowering interest rates. I did something on my YouTube walking through that. So go check out the YouTube channel.
Nice. Just what I want to a little more AJ in my life. So go check it out. Jay, what do you got?
I mean, I really wanted to plug Dave's new book, Start with Strategy. He had me write an endorsement for it, but I never got a copy of it. Certainly, I certainly didn't get a signed copy. So I cannot hold up that book. So I'm gonna endorse, or I'm gonna plug the thing that I can hold up, which was this other book by Dave Meyer, which is equally as good. It's called Real Estate by the Numbers. Never would exist without Dave, my co-author on this one. And it might exist, but it would suck. So it's a good book, thanks to Dave.
Yeah, I don't know about those J. Scott endorsements either. He was walking around the last BiggerPockets out there, and he was just giving endorsements to anyone who had a book too. So
DREdaily.com, our daily economics headlines investing newsletter. Last time I plugged it, I think we're at like 1,000 subscribers. We're at like 2,600 now.
I like to always point out the top, the whole ticker. I would love it. Now, my new favorite part of the DRE Daily is down at the bottom. If you go all the way down to the bottom of the newsletter, it has like what's coming up this week as far as like economic releases and stuff like that. And so now like that, I don't have to look that shit up anymore. Now I could just go to the read it every day and be like, oh yeah, that's next Wednesday. Oh yeah, that's coming up on Friday. And it's a great little resource. Even if you're going to skip through everything else, it's just those two things to me make it worthwhile. Dave, thanks for coming out, man. We really appreciate it. You got anything you want to plug?
Well, first of all, I just got to say you guys have done this right. I go on a lot of podcasts, and drinking while you do it really makes it a more enjoyable experience. I think I'm going to make this a habit. But yeah, if you want to learn more about residential, I wrote something called The State of Real Estate Investing. It's just a rundown of, where we are, how we got here. You can download it for free, biggerpockets.com/resources.
You can also check out Dave. What's your name? The Data Deli?
That's me. Yes.
What's the deal with that name? Deli. Where it comes from?
I love sandwiches. It's like one of my passions. And at BiggerPockets, I was a data analyst before I ever created content. And they're like, you got to make an Instagram. And I didn't even have one. And my coworker was like, the only things I know about you is you love data and you love sandwiches, so you're the Data Deli. And I just went with it.
I was going to ask a question, but I've changed my mind. Dave, offline, we need to figure out, I need to know what your top 10 favorite sandwiches are, and it's going to be our top 10 for next week.
Okay, great.
Philly cheesesteak. It's got to be up there, right?
Oh, hey, don't.
I can, do you want like type of sandwich or like from a specific deli? Because we can do both.
Let's do type of sandwich.
Okay, excellent.
You got to come up with a different Instagram name though. The Data Deli Delis.
Yeah.
Well, thanks again, man. We really appreciate you coming out. Had a lot of fun. It's always great to, we that is kind of a hole that we call ourselves drunk real estate, but most people think single family when it comes to real estate. And we kind of have that little hole in our knowledge base. And it's, we appreciate you coming out and filling in that knowledge.
Filling in our hole.
Yeah.
Yeah, fill that hole for me.
Well, thanks for having me. It was a lot of fun.
Speaking of which, I got to plug someone. So I'm going to plug my wife, Badass Investor on Instagram. Follow her and Data Deli at the same time. 2 great follows. Check her out on YouTube too, at Badass Investor. She's much better looking and much smarter than Jay. So if you're following Jay, you should be following her. All right. That's all I got. My drink is gone. I got to go hit the head. For everyone except Dave, unless you want to come back, if you want to fill in for Mauricio every week, we're completely fine with that.
He's a little worried about that, by the way, Mauricio.
I mean, this is great for me. It's like the middle of my
Worried
work
he's gonna
day
get
when you
replaced.
start recording, so I can just start drinking in the middle of the day. It's
you don't, and you don't have enough podcasts already, right? So
No.
you're just looking for more.
yeah, exactly.
But for everyone else, I will see you next Tuesday.